China's economy continues to show remarkable resilience. Recent GDP figures for the first quarter of 2025 reveal a growth rate of 5.4%. This surpasses earlier predictions of 5.1%. It also matches the growth rate observed in the final quarter of 2024. This strong performance is fueled by robust domestic consumption. Retail sales surged by an impressive 5.9% in March. Particularly noteworthy were double-digit increases in home electronics and furniture sales. Factory output also rebounded strongly in March, reaching 7.7% after a more moderate 5.9% increase in the January-February period. These figures underscore the dynamism of the Chinese economy. Despite global uncertainties, China continues to demonstrate its ability to deliver growth. This is particularly significant given the ongoing trade tensions with the United States. The resilience of the Chinese consumer and the strength of the manufacturing sector provide a solid foundation for continued economic expansion. However, challenges remain on the horizon. The escalating trade war between the United States and China casts a shadow over China's economic prospects. The trade dispute, initiated during the Trump administration, has continued to intensify. U.S. tariffs on Chinese goods now stand at a staggering 145%. China has retaliated with its own tariffs on U.S. imports, reaching 125%. This tit-for-tat tariff battle is taking a toll on both economies. However, China, with its export-oriented growth model, is particularly vulnerable. The trade war is disrupting supply chains, raising costs for businesses, and dampening global trade. The impact is already being felt in key sectors of the Chinese economy. Unless a resolution to the trade dispute is found, the consequences for China's long-term growth could be significant. The trade war with the United States has prompted many international institutions to revise their growth forecasts for China. The International Monetary Fund, or IMF, has lowered its projection from 4.6% to 4%. Similarly, Goldman Sachs has adjusted its forecast from 4.5% to 4%. These downward revisions reflect growing concerns about the impact of the trade war on the Chinese economy. Natixis, UBS, ANZ, and Nomura have also adjusted their forecasts downwards, ranging from 4.2% to 3.4%. While these projections still indicate continued growth, they represent a significant slowdown from previous years. The uncertainty surrounding the trade war makes it difficult to predict the full extent of its impact on China's economic trajectory. In response to the economic headwinds, Chinese policymakers are walking a tightrope. They are attempting to stimulate the economy without exacerbating existing financial risks. Fiscal measures, including increased government spending on infrastructure projects, are being deployed to boost domestic demand. The government is also easing monetary policy, making it cheaper for businesses to borrow and invest. However, these stimulus measures come with their own set of challenges. China's debt levels, both public and private, have been rising rapidly in recent years. This has raised concerns about the sustainability of its economic model. Adding more debt to the equation could further heighten these risks. Cracks in the facade: unemployment, deflation, and the property sector. Beneath the surface of China's robust GDP growth, there are signs of underlying economic vulnerabilities. Unemployment, particularly among young people, remains stubbornly high. This is a cause for concern for social stability and long-term economic growth. Deflationary pressures are also evident in some sectors of the economy. This indicates weak demand and could lead to a vicious cycle of falling prices and investment. The property sector, a key driver of China's economy for many years, is showing signs of strain. Investment in real estate has been declining, and property prices in some cities are stagnating or even falling. These challenges highlight the need for structural reforms to address imbalances in the Chinese economy. China's trade diversification strategy is a key component of its economic policy. By expanding its trade partnerships beyond traditional markets, China aims to reduce its dependency on any single country. This approach not only mitigates risks, but also opens up new opportunities for growth and collaboration. The Belt and Road Initiative is a prime example of this strategy in action, fostering connectivity and economic integration across multiple regions. As Chenggang steps into a leadership role, his vision and policies will undoubtedly shape the future of China's economy. Known for his pragmatic approach and deep understanding of global trade dynamics, Li is expected to steer China towards greater economic resilience. His leadership comes at a crucial time as the nation navigates through a rapidly changing global landscape. China's economic history is a testament to its ability to overcome challenges. From the early days of economic reform in the late 20th century to the rapid industrialization and technological advancements of the 21st century, China has consistently demonstrated resilience and adaptability. Each challenge has been met with strategic planning and innovation, driving the nation forward. The future of China's economy is filled with both uncertainty and opportunity. Global economic shifts, technological advancements, and geopolitical tensions all play a role in shaping the landscape. However, with its robust economic policies and strategic initiatives, China is well positioned to navigate these complexities. The road ahead may be uncertain, but it is also ripe with potential for growth and transformation.